My guest today is Kjael Skaalerud, the president of Skaling Ventures, where they buy and build a portfolio of small, enduring, niche vertical SaaS businesses. Thanks a lot for coming to the Holdco Builders podcast.
Hey, thank you for having me. It's a pleasure.
Give me some background and overview of your life before Skaling Ventures.
Yeah, okay, I'll try to be brief. So I've been in SaaS my whole career, B2B SaaS, and always in go-to-market as well. And so I started my career, I spent most of my time in New York City, and I started at ADP, which was kind of the biggest corporate kind of sales engine you could possibly imagine, but extraordinary exposure and training. And that was really a good time. I established kind of lifelong mentorships there and stuff like that. But I really quickly realized that kind of the corporate environment wasn't for me, and I was pretty far away from asset ownership at that point. So then I was fortunate enough to get some inbound consulting work. And so I was in business school at NYU Stern as well. And so that's Scaling Ventures 1.0 was management consulting. And I was working closely with the venture community as kind of like an interim VP of sales. So they would park a Series A somewhere and I'd come in, and there were pretty, I guess, obvious patterns in the work to be done. A lot of times it was transitioning from founder-led sales or moving into the enterprise, things like that. So I got a bunch of reps as like an interim VP of sales. And I was kind of starry-eyed, just like the rest of the world with like the venture capital world. I was like, wow, this is cool. We're taking swings at huge markets, big valuations, a shot at an IPO, stuff like that. But I literally had a hand in, or I guess from there, I got into operating for another venture back, or full-time operating for a venture-backed firm. And this was a vertical SaaS play. And over that period, I guess that was probably 3 or 4 years, I kind of had a direct hand in helping grow businesses to death. And I was kind of like, this venture track is interesting, but it's kind of a high risk, high reward environment. And I wanted to be a little bit more prescriptive and build, kind of more sustainable, enduring businesses. And so I made my way over to private equity as an operating partner. Chief revenue officer was the mandate, which is a fancy word for sales and marketing. So all things to do with acquiring customers, retaining customers, and then expanding those relationships over time. And there I really found my sweet spot, I think, which was kind of prescriptive playbooks, clear kind of game plan, balancing profit and growth, things like that. But I wasn't thrilled with kind of where I sat in terms of the economics and the approach. And so much of life comes down to game selection. I think I talk about it a lot, but game selection is like the most important choice. Everything after that is kind of second, third order consequence. And I was fortunate enough to, I guess at that point, I was like, all right, private equity is interesting. Buyouts are when I say private equity, I mean buyouts. But I wasn't so thrilled with being kind of an operating partner. At the same time, I started like acquire.com started to really take off. And there were all these marketplaces where for the first time I had really raw visibility into all these businesses that were out there and understanding kind of what their P&Ls look like, growth rates, retention rates, web traffic, you name it. I was like, wow, there are a lot of deals because conventionally private equity starts really at like 5 million in ARR or recurring revenue. I was like, wow, there's a whole universe out there of lower middle market firms that are really good candidates for buyouts. If I can prove to myself I can originate these deals, I can execute diligence. And at that point, I'd been on the sell side a few times, so I knew what it was like to be on the other side of the table. And so I built some conviction and made the leap. And I guess that was 2 years ago. And then in March of 2023, we made our first acquisition. And the strategy is pretty straightforward, where we're staying, it's kind of a blue ocean strategy. So we're staying below the ARR kind of threshold where conventional private equity plays because we want to avoid sell side kind of banked processes that are kind of an auction and you end up overpaying for assets. And that makes the starting line for generating an interesting return almost impossible. And if we stick to corners of the B2B world that don't have the addressable markets to support, venture-backed plays, then we're not running up against venture-backed competition who can afford to kind of irrationally spend on growth and just outspend you for acquisition. So we stay so we stay below 3 million to be safe in ARR. And then we stick to these little niche vertical elements of the business world to avoid venture-backed competition. And so all that manifested in our first deal in March of 2023.
Okay. Let's cover some things before getting into the first deal. You mentioned you were working for private equity, chief revenue officer. What were you doing there? I mean, what type of companies you helped, and what I'm trying to ask is this was like a journey for you of finding like what are your strengths. And you mentioned many times sales and marketing, sales and marketing. So I'm trying to understand like what did you do there, and how did this help you to understand uh, moving forward and doing this on your own.
Yeah, very good question. So, it was a vertical SaaS company that provided software to fund managers. So this is where it gets a little bit like confusing. So I was a private equity operating partner selling software to private equity funds. So I was kind of at all around all sides of the table, but we would help fund managers. It was like a CRM at its root. So we'd help IR teams identify and engage LPs, raise money. Once they had committed funds, they would originate deals, make investments, and it was venture and private equity firms for the most part. And then they would monitor their portfolio, report out that performance to their LPs, and ideally LPs kept investing, the portfolio kept growing, and it was kind of a flywheel, but it was really around kind of the investor life cycle. And so the mandate was very clear. And there's very much, like I'm sure your listeners have heard of concepts like multiple arbitrage, but there are playbooks where there's kind of like pools, if you will. At 5 million, there's a pool of buyers, financial sponsors, strategic acquirers, et cetera. At 10 million, there's a bigger pool of folks. And so basically with scale comes a greater universe of buyers. And so more often than not, a buyout playbook is to take something from one pool, say the 5 million pool where things trade at 3-4 times ARR, get it to 10 million and prove out a growth rate. And at that point, it's like, hey, we bought a $5 million thing for a 3 times revenue. We grew it to 10 million and we demonstrated a 30% year over year growth rate. Cool. That $10 million asset now trades at 8 times revenue. So you go from like the value creation is like $15 million enterprise value to like 80. And so it's a playbook that's really, really compelling. So that's generally kind of the mandate is we want to grow revenue at high velocity. We need to prove kind of, we can't lose the fundamentals around retention. Obviously in subscription recurring revenue businesses, retention is the name of the game. And that's the stuff that compounds over time. So in that context, or most of the time it's like, Kjael, come in, we have a founder, CEO who's doing a lot of the selling. Maybe they have 1 or 2 account executives, which is like the most conventional term for a sales human. And it's basically build a sales-led growth engine. And how, like, and I guess everything's relative. So sales-led growth is distinct from what's called PLG or product-led growth a lot, but that's since kind of been debunked, and it's really kind of user-led growth. So the distinction is, who are you selling to? If you're selling to kind of small, mid-sized businesses, usually you can get away with a user-led growth motion where they come to the website, they participate in a trial, or maybe there's some freemium type tooling, and then you would convert them to a paying customer, but there aren't very many humans involved. It's a very low touch model. As an alternative, sales-led growth implies you're selling more to like mid-sized businesses, enterprise businesses, and you're conducting sales process. So there's a human executing discovery, understanding pain points, understanding all these different kind of variables and attributes. You do demos of the technology, you put forth catered proposals, you close it. There's humans involved in the implementation process. There's a lot of scoping. Maybe there's some proof of concept, et cetera. So most of my career was built around building these sales-led growth engines. And that's usually an operating model that involves account executives that are doing the selling, solutions consultants that are doing the demoing, implementation teams that are activating the users or the customers, and then into customer success, which is all about adoption and retention and ultimately expansion. So I had my hand over the data model, the operating model, the incentive structures, the pricing. And I guess pricing is a kind of pricing is the biggest lever, or, I can save everybody the cost of business school. There are 2 ways to grow revenue. You can sell more widgets or you can sell the same number of widgets for more. So pricing should be as much as a third of your go-to-market strategy, because usually that's, and a lot of times you can assume that founders aren't super commercial savvy. You ask them how they got to pricing. It's like, we just looked at our competitors and this seemed about in line with where we think we're positioned, or it sounded right. Like you get a lot of inputs. It's like, oh boy, okay, so pricing and monetization is something that needs to be considered as well. So my role was always kind of that full kind of customer life cycle and thinking about the components and the metrics and all the other things.
Well, you covered a lot, so I want to get into all this, but you mentioned such an interesting thing, importance of game selection. What are your thoughts on this? I guess how I view this is I'm trying to rely only on my strengths, and whatever is my weakness, I try to find a partner or hire someone or ask from a consultant. What are your thoughts on this, and how does it? What I mean in here as well is like, does it has anything to do, like, who do you want to compete with? Because when I started my journey on with those traditional businesses, before that I had this idea maybe doing something in SaaS and in venture capital, but I met a lot of people here in Northern Europe. I went to around Europe. I talked to guys in Australia and USA, and I pretty quickly found out that, okay, I don't want to compete with those people. They are, it seems like, too smart, and I'm not that smart. So the game selection, I think it's so important. Then I took like a week off. I went to Qatar. I just spent there, and I was just thinking of what I'm gonna do next, where I have a highest chance of winning. And I believe I found this. It was a long journey, and now I see that this was a great decision. So a lot of talk from my side, but what are your thoughts on that game selection?
Well, I mean, game selection is really, it's obviously, that's a huge question. Like, we could spend hours and hours talking about it, but I think the first and most important thing is to really think about goals. What are your 10-year goals? And I think we're conditioned to kind of inherit society's definition of success. And we obviously live in capitalist kind of consumer society where, the goal is to have a private jet and just blow it out of the water and be a multimillionaire and consume all this cool stuff. And I'm not sure that is aligned with a lot of people's values if they stop and think about it, where it's like, do you want to be a billionaire, or do you want to settle for multi-million, not to say settle, or settle for some kind of less ambitious kind of economic goal because you would rather have dinner with your kid and your wife every single evening. So I think the first and most important thing with game selection is kind of backing into what your long-term, or you're establishing long-term goals. And I think a lot of times goals are half-baked, where it's like, I want to do this. And it's like the other side of the puzzle is, what are you willing to give up, or what does it cost to kind of materialize those goals? So once you get there, and that's where, for me, the venture capital track didn't make sense, because it was, a 1% chance at multimillionaireism. And I was like, I don't want to be a multi-schmillionaire, and I'm not willing to sacrifice my entire life and eat peanut butter and sleep on my office floor until we get there. So those are some things where I think originally you just kind of have to assign a magnitude to your goals financially, and then start to think about what is required to get there. And then obviously you want to play to your strengths. And in that sense, it's like, where do I have evidence of being elite in a certain category, a certain discipline, something like that, and being very clear on kind of doubling down on your strengths, because it's way more effective to be elite in one or two areas than it is to round yourself out and try to be a generalist, at least in my point of view. So then it's being very clear about, okay, who do I need to surround myself with? Like, in my context, I don't write code. I don't know shit about writing code. So I need a technical counterpart. I think RevOps and other elements like that are mission critical as well. And I sometimes glaze over and am not detail oriented in certain contexts. So I need to round out myself that way. But I think ultimately game selection is, just a function of, cool, what are my goals? Okay, this assigns kind of a magnitude to what I need to achieve economically. Where am I strong at? This kind of applies what my biggest point of leverage is in really any context. And then you start to think about the fundamentals or the physics around you. And so for us, it's, again, a capitalist society, which means it's all about asset ownership, right? You need to own assets that produce cash flow. The more cash flow, the more valuable the assets. And that's ultimately the game you're playing. Because for me and my trajectory as well, it was very frustrating to be like, okay, I just did XYZ $1,000 worth of consulting. I circle back up with the founder, 2 years later, and it's like, wow, that work you did helped us grow revenue by X and created $10 million in enterprise value. And it was like, damn, I got paid 100th of the value that I just created. That doesn't seem to work out to me. So a lot of it is kind of like the engagement model. And I think over the course of my career, a big realization is that I'd been playing the game of capitalism the whole time, and I didn't really know. Like, I didn't really appreciate that, like, or like in a private equity context, it's like the capital allocators get 90% of the economics because they bring capital to the equation. And it's like, okay, my number one job is to create surplus capital for my family. And then I've got really good evidence as an operator that I can create value in a business and transformation and et cetera. So if I can solve for the capital side, it gets very interesting. So I think that's probably the best I can do at answering the game selection, the question without talking your ear off for the next 2 hours.
What do you think? How much value did you create before you left on the private equity fund where you were helping this CRM-like business?
Yeah, so I mean, I'm not so sure how.
Did you set everything up and then you left, or how was it? Or
No, we set everything up, executed, and then led kind of the actual exit. So we saw that through full life cycle. But in a private equity context, the executive team is usually getting access to the option pool. So that's 10% of the equity, which is distributed across 4 or 5 executives. So at most, you're getting 2% equity, something like that, if you're an executive. So that kind of gives you a sense of the magnitude of value creation and then how much the talent is able to capture in that. And it makes sense because obviously transformation doesn't occur without the sweat, but accumulating surplus capital is the hardest thing in the world. And so that's why the capital allocators end up capturing the lion's share of the economics. But I can speak, more specifically at firms that we've, like with acquisition number 1, I guess the money on invested capital was like 2.67 times. It was a really short timeline. It was only 17 months, but we created probably 30% increase in enterprise value on a 17-month timeline.
Okay. One more personal question when we get into this acquisition you did in March 2023. Financially, where were you before taking this leap of, okay, I'm going to build my own business, I'm going to start Skaling Ventures?
Yeah, because I guess this kind of hints on like a concept that I refer to as escape velocity, which is the hardest thing for an entrepreneur, is like, how do you create the conditions that allow you to leap? And there's a spectrum. And I think this is where venture capital comes in a lot too, where it's like, I've got a really good idea, or I've been moonlighting and developing this idea, and I've got some paying users, some paying customers. But for me to make the leap, I have to cover $100,000 of expenses for my family to be comfortable. So getting to that place where you can, and obviously pressure and constraints are good, but you want to be financially secure enough such that you don't kind of have this constant cortisol drip on your brain that's just, fear. So escape velocity is an important concept. And that's where I guess acquisition entrepreneurship gets interesting too. And that's where you start to see like the search fund models and things like that, where it's like, we'll pay you a salary for 1 or 2 years to originate and find an acquisition. And then you can draw income from the business that you acquired. And you're also, more substantively involved in the capital stack as an equity holder. So that's where a lot of escape velocity is created, is kind of like bridge financing to help you cover your make ends meet while you find a business. So for me, I had a small kind of liquidity event and, not crazy surplus capital. And then I formed a partnership with a kind of a search fund type arrangement where they were willing to cover my income in exchange for an equity slug in the subsequent deals as we built the portfolio. So that's where I kind of achieved escape velocity. But I wasn't in the place where I was like, yeah, I've got $1 million in the bank, I can take a couple years to go figure this out. Like, it was like, I've got my income and kind of bases covered and my real needs covered. I can jump in, and I wanted to start playing the game immediately.
So take us to the first acquisition. You mentioned you found this from acquire.com.
There was a sell-side advisor involved. So it wasn't necessarily like a third party. So it wasn't necessarily like a conventional marketplace kind of deal. But that's where I originally caught wind of it. And then we just pursued it from there. And it's basically, it was a business management suite for creatives. So event-based creatives. So think DJs, wedding photographers, things like that. And very straightforward. And this is where you start to get the saying of like, all SaaS tastes like chicken. And it's like, well, at the end of the day, you got 3, like in a B2B context, there's really 3 pillars to this, or 3 legs to the stool. You got to manage your customers, which is a CRM. You got to manage your books, which is an accounting or ERP tool. And you got to manage your people, which is usually HR tech, human capital management tech, whatever. And so those are pretty universal across businesses. And where you start to see vertical SaaS compete is when they cater to the nuanced kind of edge cases that are specific to a category. Where some of the bigger, like a Salesforce or a HubSpot, if we're talking about CRM, they're like, we want to try to solve 60% of everyone's problem. And you're like, I want to solve 100% of this small group's problem. And you compete on that. So this firm, our first acquisition, helped these folks, capture leads, send proposals, send invoices, get paid, coordinate the events amongst their staff. So it was mostly CRM with a little bit of bookkeeping and a little bit of personnel management.
How many businesses you were looking at, like before making this decision of, okay, we should move forward with this one?
Yeah, so I was at it for about 90 days, call it, until we went to LOI, and then you kind of cut bait. Once you get to LOI, you just totally fixate on the deal and have every intent of closing. And I probably looked at 300 deals. I've got really thorough data and a CRM that we kind of built via Notion. And I guess when your job full time is to look at deals, man, you can spend a lot of time looking at deals. So there's just a whole universe, and there's obviously different channels that are available to you. And the marketplaces are probably the lowest hanging fruit, but they're competitive. So you need to move fast. And if you're depending on your financing, if you're utilizing any debt, most of that, the debt underwriting takes 60 to 90 days. And there are competitors that are maybe just pure equity that can close a deal in 30 days. So it's tough to compete on speed in that context. And a lot of people win based on speed. So enough to establish a really relative point of view. And that's the other thing too, like everything is relative. So it's like, is this house good at this price? It's like, I don't know. What is other houses with 3 bedrooms and 2 bathrooms and blah, 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 blah. What are they trading at? So you have to stay in the game for a little bit just to establish a relative point of view, or else you're kind of shooting in the dark. So after that, we had really objective data that we could compare around, fundamental metrics, growth rate, EBITDA, rule of 40, stuff like that, logo retention, growth rates. And then you can start to nail down, okay, of the deals we've seen, what's top quartile, what's 90th percentile? Can we get there on valuation? What's the business worth now? What's the business worth if we're able to execute the transformation play, or just like a generic growth, assumption, etc.
So looking at 300 deals, even though you have the whole day, you don't want to spend too much time on the ones you're not going forward. What are the 3 things you look at? You look in it once you see the list.
Yeah, for sure. So the first part is kind of the ARR threshold, and we've moved up market a little bit, but we're looking for 1 to 3 million in ARR. For the first is niche vertical B2B SaaS. So, and then you have to quantify that because it's a little bit subjective. So it needs to cater to a category that has no more than 250K business entities in the States. And you can look at that. And we want to look for fragmented too, where there aren't a few enterprises that totally own that niche, right? Because then that means, okay, we need to, like, we can grow revenue, but we need to sell 2 giant enterprise accounts. And if we're not effective, we don't go anywhere. So you look for fragmentation or a normal distribution of enterprise, mid-market, SMB, et cetera. And honestly, the niche vertical B2B part is the hardest because there's just not a ton that fit kind of in that category of the world. So we qualify for niche vertical B2B SaaS, then we qualify for ARR, and then we look at logo retention. So those are probably, and I have like a 5-component scorecard, but in a sentence, it's profitable niche vertical B2B SaaS firms generating 1 to 3 million ARR with some growth, probably around 10%, great logo retention, which is north of 95%, limited go-to-market expertise and investment, fragmented competition, and technical founders.
Okay. 2 things, 2 structures. Could you share the structure of this deal and the structure of Skaling Ventures? Are you doing it alone? Do you have partners?
So I have Skaling Ventures is kind of like my own entity. So I have the kind of very long-term partner, which I disclose, who's kind of a riff on a search fund arrangement. But that's a very long-term, like they're kind of committed to covering my income in exchange for participation in equity and all of the subsequent acquisitions as we scale towards a portfolio. But that allowed me to take my income out of the equation, which was very productive. Outside of that, Skaling Ventures is its own thing, and it's kind of like the holding entity that takes positions in all the businesses that we acquire. And then we aspire to pivot to a holding company in the future, and there's just a lot of benefits to that. And I know Holdco builders, your audience is familiar with that, but like pooling earnings, using cash flows from one business to finance the acquisition of another, it starts to get very interesting. There's a lot of compounding kind of elements there. But that's what Skaling Ventures looks like. And it's, if you think about maturity, we're very early on in the game. So I think we aspire to pivot to a holding company probably after this next acquisition. In terms of like conventional deal structure, I can speak to that more than I can speak to like kind of specifics for us. But the SBA is an incredible mechanism in the States where you can, and for people like me that are mostly sweat but don't have surplus capital, when you utilize an SBA loan, you have to sign for it personally. So if shit hits the fan, there's a bankruptcy at the end of the tunnel. So it is risk on. It's as risk on as it gets. But because you assume such risk, that capital is recognized like your capital in the deal. So that allows you to get out of the, 10, sub 10% or up to 15% as the transformation CEO, because you're just bringing sweat to the table. You bring what is perceived as significant capital to the table. So then you'll start, I'm sure your audience knows this too, but like there's ways to get deals done with no cash, where it's like 20% seller financing, 80% SBA loan. But I think probably the most conventional structure is 20% cash from investors, friends and family, whatever, 10% seller note, and then the remainder SBA debt in kind of this lower middle market SMB, deal search entrepreneur tranche. There are other flavors. I think acquire.com is on the record where it's like a third cash, a third seller note, and a third earnout. And so there's no bank involved. So that's another kind of conventional structure. I think the thing to note is, there's a reason that they don't call them BOs, buyouts. They call them LBOs, because there's almost always leverage of varying magnitude in the mix.
So the first deal is oftentimes most important. It's track record. Now you have a track record. Now I think it raises your own beliefs because you're doing it on your own. What changed for you if you're thinking back now? It's November 2024, so it's almost like 18 months since you bought the business. What has changed?
Oh man. Well, I think job number one is every morning you wake up is to drown your ego in the shower, and it's like, you do not have the Midas touch. Like there's too many variables in play to ever think, I think, and as everyone will say, luck is a factor, or there's just too many variables to control. With that said, I think the universe rewards risk appetite and executing and bringing the best version of yourself to every day. And a kind of a constant pursuit of growth too, because you're very much a limiting factor in the business, right? Like as a CEO or whatever, you have to push yourself forward and acquire new skills and new knowledge if you're going to be able to translate that into the business and take it to another level. Or put another way, if you want to do things you've never done, you've got to do things you've never done. So I think when I look back, the realized track record is very productive, especially with some investors, but there's a little bit of a gotcha there, where it's like, hey, but I guess at the beginning, it's like, hey, this thing should sell for this in the future. And it's like, okay, no, I don't believe that. And then when you do realize an exit, most of the folks that challenged you about not having a realized track record are like, all right, one's lucky, two's a coincidence, three's a pattern. So you're on your way to a realized track record, but you don't necessarily have one. So I guess all to say, the bar is always elevating. And I think expectations are very high, because if you compare us to other SaaS buyouts, and it's not apples to apples, we just did one transaction. It's not kind of the average across the whole portfolio, but it put us in the 90th percentile of our peer group. And so the expectations are very, very high. But I do have a degree of confidence because we're very data and systems driven. And I've been building in public, so I can literally look and contrast is a beautiful thing, right? And things that are subjective, right? Where it's like, what's good art? I don't know. But if you put bad art next to good art, it's like, oh shit, that's the good one. So contrast is a very productive thing. And so when I just look at contrasting where we were at 2 years ago and how I was thinking about things and how we would do diligence and how we would think about transformation plans versus now, and there's some principles that we kind of adhere to, but simplicity as mastery is probably one of the most important for us. And it's like, damn, when I look back, it was just so noisy, and there wasn't like a ruthless sense of operating leverage. It was like, we're going to do all these things all at once. And it's like, well, then you're going to do nothing at the same time. You're just running in place. So I look at our stuff and it seems like we're just kind of continuing to split the atom further and further down and getting to the root of what generates performance, the root of, kind of what creates risk. And we're just getting cleaner and simpler and more repeatable and more data driven. So that's kind of how I look at where we were at 2 years ago versus now. And I think also just subjectively, you have to kind of have some self-awareness. And I'm like, am I a more dangerous business human than I was 2 years ago? And I can tell you that the growth curve, the learning curve, the last 2 years was as steep as it's ever been in my life. And our job, as entrepreneurs, as humans, is to stay in that deep part of the learning curve. So I think, you're in the right spot that way. And so when I look back and I'm like, damn, I learned more in 2 years than I did across probably the span of my entire career. And when I contrast how I was thinking, and that's back to whether you build in public or not, I think it's very important to document decisions, to document whatever you can, because contrast is the best way to tell if you're making any progress.
You mentioned many times building in public. What have been the pros and the cons for you on your journey?
Yeah, my gosh. Honestly, It was probably the most important decision I ever made. In a business, or it's top three for sure. I mean, I think it led to this conversation. It's led to extraordinary, stimulating, thought-provoking conversation, discussions with talent, and exposure to investors. And so I think 1.0 is no matter what you need. My advice is, you document your journey no matter what, so that you have something that's kind of materialized in a place that stays put and you can go back and look at it. And then if you're going to build, if you're going to be documenting that stuff, you might as well share it. And I think that's another way to just like further stamp it, where it's like, I posted this thing in a blog on this date and you can't take that back. It's out there, it's in the ethernet. So I think building in public for me, part of it was to kind of writing letters to my future, or writing letters to myself in the past. And that was part of it. And I think there was an altruistic component too, to inspire people about this path, because I think a lot of people are frustrated at a venture-backed company or at a private equity owned company or in a corporate setting, or they're consulting. And this is a path that I think is kind of the best of all worlds. So I did want to inspire folks, that there is another path that's available to them that's very compelling and that gets to the heart of capitalism and wealth creation and financial independence and doing it on your own terms and all that kind of good stuff. But the building in public stuff, the other benefit is, if you think there were so many times where I thought that I had a really tight grasp on something, only to have to really convey it and communicate it simply, and realizing like, shit, I did not have the depth of knowledge that I thought I did about this topic. And as a function of building in public, I had to really sharpen my point of view. And so it's a very productive exercise in just sharpening the axe as you go.
What about the focus, running the business versus wanting to share of what you're doing?
Yeah, well, if you do it right, it shouldn't take additional time. So I think that's the biggest element of where it creates leverage, right? It's like you're just kind of polishing and distributing the work that's already being done. So, and there's different ways and content distribution models and things to think about it. But it's like, building in public can be recording your weekly executive meeting or whatever. Like, it doesn't have to include any type of incremental work or lift. And then once you have long form, you can repurpose it into a wide range of short form, and then you can just distribute across different platforms, et cetera. So content generally is a big point of leverage. Like, if, for the folks that are read Naval, Robbie Kahn, and think about you've got capital, labor, and content and code. And those things all scale very, very well. Labor, not so much, but capital, code, and content scales very well. So usually investments in those types of assets are better than a one-to-one return, which is the name of the game, is kind of sniffing out those opportunities for operating leverage.
Okay, changing the topic a bit, post-acquisitions, first 30, 60, 90 days, to have like a playbook or game plan, or what you're going to do?
For sure. So we have a very defined playbook that I would say is probably 70% universal. And then the other 30% is very dependent on the context of the specific acquisition. And I actually just did a Substack post on this, kind of what that first 90 days looks like. But I think the thing that you don't want to do is come in and start changing everything. Like, the first priority is stability. And it depends, again, like, you probably can assume that there's key employee risk in any of these deals, because it's kind of bootstrapped CEOs that are touching product, touching support. Maybe they touch marketing a little bit, but you probably assume there's not much marketing happening. But a ton of the edge and the domain expertise, the institutional knowledge, the tribal knowledge, however you want to call it, is between the founder's ears. So the first order of business is to document and extract as much tribal knowledge as you can, convert that into SOPs and procedures that you can train people against, that you can hire into. Obviously, the more stuff that's documented, you can train LLMs on it. And now you have this natural language thing that you can chat with to help you figure out what the hell is going on. So that's another big point of leverage. So I would say the kind of headlines and we think about like the first quarter. So the first 90 days is stability, documentation, and then visibility. So you want to make sure that no matter what, you're not disruptive to the business. And the number one thing is you don't want to see customers churn. So you have to be super thoughtful about customer communication. You have to think about the folks that are transitioning out of the business as part of the deal and backfilling them and understanding what their work streams look like, their KPIs, their perfect average week, et cetera. You want to be documenting everything you possibly can. And then you want to be creating raw visibility into the business, because a lot of times the tech stack or the operations are very fragmented. So it's like, we've got revenues for our customers and our accounting thing. We maybe have a CRM, but it's probably a spreadsheet, and support tickets come in through email. So the first order of business is to centralize all that data And then you can start to use analytics to quickly comprehend it. You can find patterns via analytics. And so you want to emerge from that first 90 days with a pretty airtight analytical kind of perspective on the business and probably V1 around the scorecard. Like, all right. And then that's back to like everything's relative. So it's like, we know that and this is another thing I wrote about, and you'll see, I'm going to say that a bunch because it's like anything we've thought about and worked on, we've shipped, so you think about like objective base rates, like what does sales velocity look like? Let's look at our trailing 12 months. What does the time to resolution for support tickets look like? What does the product feature release velocity look like? And once you have those base rates, then you can look at benchmarks compared to your peer group. And you can say, okay, we're underperforming here, we're overperforming here. Or you can start to think about just a rational rate of improvement. Because a lot of times you come in, it's like, hey, let's grow at 300%. And it's like, all right, well, that's basically like, I want to bench press 1,000 pounds. And it's like, okay, well, how much do you bench press now? 100 pounds. It's like, all right, how much do people that are 160 pounds and 6 feet tall bench? It's like, no one benches 1,000 pounds. So like that goal is totally irrational. And you want to just get to a place where you're outperforming your peer group. And if you don't have benchmarks like that available to you, then you want to be thinking about a relative rate of improvement, which is like, I'm going to add 10 pounds to my bench every quarter, something like that. So you want to emerge with a really relative point of view. And you can get to this point of view during diligence, but it rolls right into the first 90 days and into the transformation plan. But I think the headline is, you don't get in there and start changing everything. You get in there, you keep your mouth shut, you observe, you document, you learn, you validate points of view, and you try to drive visibility across the whole business so you can actually, improve what you want to measure, or measure what you intend to improve.
What about the team? Did some people leave? How was the CEO, the management team? Very small business, obviously, but how did it all go?
Yeah, so for me, like, most important for me is kind of like a technical operations lead, or what's called RevOps, even though that title makes no sense. But it's basically like, what's the technology? And this is back to like, every company's a tech company, whether you think it doesn't matter if you're selling software. It's like the lifeblood of the business runs on technology. You're a technology company. You need to have a sharp point of view on the systems that you have in place, how those systems connect, how you harvest data, how you utilize data. And the terminology for that is a tech stack or an operational tech stack. So I have a counterpart who's a head of technical operations, and he's basically execution, implementation. And in that capacity, it's my job to be clear on like what's possible in the world, but I don't need to get to a level of detail where I understand how to execute it or what the technical components are. So he's my right hand in most ways. And then I have a CTO, transformation CTO, who rounds out a point of view on product roadmap, staffing of engineers, how we think about that stuff. And that's purely just shoring up what's one of my blind spots. And then we have a group that manages design, and they kind of oscillate across product design and user experience all the way to kind of brand and creative identity. So those are kind of the four elements that you want to bring that we bring to the table. It's me as the CEO. And you should always assume that the CEO is probably exiting the business. Like, they're probably the majority owner. Maybe they'll roll some equity. Maybe they'll stay on in an advisory capacity. But the other thing to know is, when the money hits their bank account, no matter what they say, their engagement is going to fall off a cliff. So it might be like, oh, I'm excited to stay in the business. And you have to assume that there's some degree of burnout, because they've been spinning all the plates for many years. So they're probably pretty crispy. And when that money hits, it's like, actually, I don't really care how this pans out. So you got to be prepared for that and have a plan and be ready to step in and assume those responsibilities.
So how has been the 18 months? Expectations, reality, how has it been?
Yeah. So, I mean, and you have to also, like, some other assumptions in like a SaaS acquisition context is there's always technical debt. And so I always use the metaphor of like a home. Like, assume that the plumbing's a little janky. Assume that the roof is probably pretty beat up. And so it's like, hey, we want to put a new kitchen in, but to do that, we've got to fix the plumbing. And nobody sees the plumbing, and it takes a long time to fix, and it's expensive. So there's a lot of tech debt and that all kind of translates into velocity and how fast you can move with the product. So our first acquisition, there was a lot of work to do on the product. And we kind of think about that as like eating your vegetables, because obviously dessert for us is the growth. So there was a lot of lift to do on the product side, and stuff that maybe wasn't necessarily obvious to users because they only see what they see, right? And they're like, we don't care about the toilet as long as it flushes. And it's like, yeah, but maybe next time it's going to explode, and we're going to fix that for you, but you're not going to see it. So it's not very flashy, a lot of the work that you have to do. But when I look back on it, it's like we ate a lot of vegetables and we fixed and structured and professionalized a whole range of attributes around the business to make it more turnkey to operate, which is obviously translates into enterprise value, or it translates into sellability, where it's like before, who knew how this business works? Now we've got an index of SOPs, we've got KPIs, we've got analytics into the business, et cetera. So it allows another person to step in and have confidence that they can operate the business, which translates directly into the likelihood of a transaction, et cetera. So I'm not sure if I'm answering your question, but it was a lot of eating vegetables. And I think the bittersweet component, because the whole period was so short, is we planted a lot of seeds that we don't necessarily get to see grow into fruit. And I'm still going to be involved in that business as an advisor. So I guess I do get to see how those things pan out. And that always comes into like the timing, and I think that's a very relevant thing for a lot of sellers is like, when do you sell your business? You don't want to sell prematurely before you can kind of harvest the farm, et cetera. So I don't know if that answers your question, but hopefully a little bit.
Yeah, eating vegetables. You want to say it has been more painful than you thought?
No.
More work? I mean,
no. I mean, for me, I knew it was a full-time job, and I knew I was going to be hustling my ass off, and I knew that there was personal risk because of the SBA loan. So there was no margin for catastrophic failure, or any kind of failure was catastrophic. And that's, back to like the Warren Buffett, or you can suffer body wounds, you can't suffer mortal wounds. So when in that context, true failure is not an option. And so you fight like hell. It was a lot of work, but it was fulfilling work. So it didn't feel like I was doing work. It felt like I was working and improving something that was an asset that had, significant value, that there was value creation occurring. And that stuff's all very motivating to me. But make no mistake, it is hard work to acquire and own a business and transform it and make it more valuable. But to me, I can't imagine anything more fun or cool than that. You sniff something out, you buy it, you make it more valuable, you hold on to it, collect cash flows, you sell it if a good buyer comes around. I think in many ways that's the name of the game. Or I don't know, that's my game. And that's, I guess, a flavor of the game selection I spoke about.
Can you share some of the numbers, or you prefer not to?
I prefer not to, because a lot of it's not really public yet.
That's fine. When it comes to growth strategy, do you consider doing some add-on acquisitions, or what's the plan there?
For sure. Interesting data point. It's like 75% of private equity buyouts are add-ons. So make no mistake, this industry is about add-ons. And for the majority, they're like, hey, we're going to buy a thing that's at $10 million and trades at an 8. Basically, anything we buy that's below an 8 is immediate enterprise value creation. So if you buy a thing that's trading at a 4, it gets absorbed into this thing that's trading at an 8, overnight value creation. Obviously, integration and all that other stuff is very challenging. So it depends on kind of what your approach is, especially in software. It's like, hey, this product's written in Portuguese, this product's written in French. You can't just smush them together. I'm sorry, what was the base of the question?
Add-on acquisitions in your own case.
Yeah, totally. So I think you have to have a point of view. And it's funny because I was trying to get in the game. And so I didn't have a very shaped point of view on what roll-up opportunities were available. And I regret that. I wish I had slowed down a little bit more. I went to Capital Camp last summer, I guess it was. And it was like roll-up central. I'm rolling up towing services. I'm rolling up HVAC. I'm rolling up. And it was like, wow, okay, I need to think a lot more about this. And so I think roll-ups are an incredible way to create growth. And I think, shame on me. I was just so used to being the organic growth human that inorganic was corporate development. And if that happened, happy days. But especially another kind of saying that I've kind of held with me is anything that ascends consolidates. So at the end of the day, things that outperform and do well end up getting consolidated. So no matter what, as you work your way up the pecking order, usually there's consolidation of something happening. And especially because at some stage, hypothetically, there's a market that you can fully acquire. So the growth is no longer available. You've saturated the market. The only way to grow is inorganically via acquisition. So it has to be part of your thought process. And let's just say, if I compare the first acquisition investment memo, it's kind of laughable to what we pulled together. But as much as a fifth of this one is about add-ons and a thought process around consolidation, roll-ups, if you want to call it that.
What about the competition? I mean, there are a lot of people who are listening, and some of them are in this zero phase. They haven't made an acquisition yet. They putting together like a deck. They would like to raise capital to build a holding company, and it's very hard. But the goal is the Constellation software. So you are you have you are so-called successful in this because you have done your first acquisitions. So now again you have your track record. You have proved proof that you actually can do this. You've been doing this, so and you're in the game. So how much competition there really are on the deals, and when actually seeing this building much bigger?
Yeah. I mean, and competition's dynamic, right?
Because
Like,
there is so much theory about this, that Constellation software, it's crazy successful. I don't know what's the stock price at the moment. It's insane how much value they've created. So a lot of people want to do this. So how realistic it is, I don't know. I don't know about software that much, software roll-ups. You're in this game, so how is it?
yeah. So a lot there. Well, and I think according to theory, like in a market that's at equilibrium, there is no profit, right? Competitors will come in and compete away whatever the profit margin is, and it goes away. So in perfect competition, total equilibrium within a market, there is no profit. So that's why competitive dynamics evolve over time. So I think at this point in time, most of the competition is up market. Most of the financial sponsors, the lower middle market buyout private equity shops, very, very competitive, which means that there's more people who want to buy stuff than there are people selling stuff. So in that regard, that's red ocean, right? There's tremendous competition. I think as you move into different areas, the competition and the profile changes. Obviously, Mark Leonard, and he's considered the godfather of like this permanent hold vertical SaaS roll up strategy, and it's just a compounding eighth wonder of the world. And in his market segment, it's highly competitive because word gets out. Oh my gosh, anytime you hear like extreme profits, right? Eventually, word gets out and competition comes into the game, and the dynamic changes. I would say in kind of the lower Micro-SaaS market, there's way less sophistication because those folks, I mean, the old saying is do the biggest deals you can. Or if you're going to try to fly to the moon, fly to Mars, because Mars is a lot cooler and it's probably the same degree of difficulty when all is said and done. So I would say it's relatively still blue ocean, but that's this quarter, like ask me in a year from now. And I think what we can probably assume is that eventually it's perfect competition in every market, and there's no profit margin to be had. You're just trying to, break even.
And what's your goal with this specific company you bought? Is it buy and build and keep it for some time, or you're pretty much waiting for a right buyer to come and to sell it and move on to do a next one, or in which phase you are at?
Yeah. So I think like base case, we think about holding periods in like 5-year timelines. And obviously we're opportunistic when it comes to exits, and especially like if a strategic comes along and they can rationalize a very big valuation, you kind of have a fiduciary responsibility to explore that, to your investors and to yourself. But all to say, I don't, at this point in our strategy is evolving in that sense in terms of like a longer term timeline. But as it relates to like, okay, we own this business, it's, there's free cash flow that it's spinning off. I think the de facto, I guess, reaction to that is to reinvest in growth, because that's what unlocks the most enterprise value versus giving a distribution to investors or paying down debt or doing stuff like that. It depends a lot on the mechanics of the debt. But our strategy generally is a 5-year hold with most of the transformation activities happening in year one. So it's kind of an assembly line where and this is where if you kind of just invert how typical private equity works, that's probably what we do. So instead of having and there's flavors of operating partners, but for the most part, a lot of them are kind of external subject matter experts, advisory. They're not in the trenches operating. And that never made sense to me. It was like, why don't we have the most competent people execute the transformation? And then once the train tracks are there and the trains are on time, we slot in more of a steady state team. So we have an assembly line type approach where the lion's share of the transformation should happen in year one. And then in terms of growth too, a lot of it's experiment driven. So, you basically turn some dials and you need to give it 90 days to see what the results are. So the time intensity past year one goes down a lot. So that's where, we aspire, I think probably a portfolio of, no less than 5 firms on a 10-year timeline. And we're swinging at cumulative 15 million plus in EBITDA.
And what about the next deal? Have you already been looking for what you're wanting to acquire, or all your time has been spent on the deal one?
Yeah, so we're under LOI for our second acquisition. And so we are just got through technical due diligence. We're formalizing a debt lender and getting that piece secured. And then we move to quality of earnings and then kind of structuring the purchase, the stock purchase or the asset purchase, depending on what you're doing. So I think smooth sailing, we would finish or take possession of acquisition number 2, call it February 1st of 25 at the latest.
So how is it? The first company, it's profitable now. You can reinvest some of the earnings, or how does it work? How do you think of structuring the holding company on the holding company level?
Yeah. So that's a very good question. So I mean, we, like the old saying is, can the business afford itself? So if you're using debt, you have to have cash flows from the current business to prove that you can service the debt and pay off the loan that you're using to buy the business. So there has to be some cash flow, and that's probably on an adjusted basis, because when you look at the P&L of a lot of these businesses, there's a lot of what are called add backs, which I'm sure your audience is familiar with, but you want to get a point of view on what the adjusted earnings of the business are. And then that gives you a sense for, it's like, all right, the business is kicking off 500K in earnings. That means we can have up to 400K in debt, which means the loan can be $3 million. Okay, we've got 3 million that we can point towards the valuation to make the deal. So that's generally, to get the deal done, it has to be cash flow positive, probably to the tune of 20% EBITDA margin or adjusted EBITDA margin. And then the other premise is that, we don't bring a ton of capital, like growth capital, to the equation. So we're funding growth with the cash flows from the business. So back to kind of our headline is we need to see decent profitability on the business to finance the debt and to fuel growth.
The goal is 15 million EBITDA in 10 years in a Micro-SaaS landscape. What do you think? Currently, it's a blue ocean. Do you see it will change? Because today it's 2024. Let's say you want to do a deal 2030. You think it's going to be extremely competitive?
It's tough to say. I mean, I think competition follows the returns, right? And then over time, competition erodes the return potential. And I think there's still kind of macro principles at play where you want to do the biggest deals you possibly can. And especially from an LP or a capital allocator's perspective, there are a lot of investors that can't look at anything that's less than $1 million check, because it's just an opportunity cost. Like they're like, I'd cut you $250,000, but then I got to fill out these documents and have my lawyer look at this, and the juice isn't worth the squeeze. So I think there will always be a critical mass of competition where the scale is. And then it's just a function of like, all right, do these things become perfectly competitive over time? And I think there's reason to believe that most markets do. But I would say today it's a yellow ocean or whatever. Like there's, competition enough for it to be competitive, and it's not like a total buyer's market. And then you have some other macro trends that are interesting, especially in the SMB category, like the silver tsunami, where all these baby boomers, you've probably been beat over the head with this, but it's like $1 trillion in small business value is going to change hands. So that implies that there is going to be a surplus of, stock on the business side. So there will be more businesses for sale than there really ever have been, which should reduce the competitive dynamics, because I don't think the volume of buyers is going to grow at the same clip.
So you want to get better as a business owner, as a buyer, as an investor. What do you consume in order to get better at what you do today?
Oh, that's a good question. I can tell you the book that has rocked my world the most as of late is Revenue Architecture by Jocko over at Winning by Design. That book is absolutely incredible. Absolutely incredible. He starts with like first principles, data models, operating models, all kind of under the premise of subscription, recurring revenue-based businesses. But I think it's a useful read for anybody under the sun. It's like straight up gospel, if you ask me. And I use Reader. So I have and I did a post on this too when I tuned up. And I think you have to see content and learning as a diet, and you need to be as intentional about that as possible. So I keep a really curated backlog of long form content. So it's like a book list that's, whatever. And you kind of sequence the backlog based on what's a priority. And I try to diversify across like industry knowledge, technical knowledge, macro, and fun. Mix some fun in there so you don't go crazy. So I have like a very curated book list, and then I have probably 10 email newsletters that I subscribe to, and I consume those via Reader. So you want to get out of your inbox, that's distraction central. And then I'm pretty thoughtful about my Twitter following too. LinkedIn is just too noisy. Like I don't know, I have too much action on LinkedIn, so I can't really tune that up in terms of who I follow. The algorithm's pretty good in terms of what they serve up, but I'm really thoughtful about my newsletters, about my podcasts, and about Twitter.
And when there is a serious, like a, sorry for my language, like a oh shit moment in your business, who do you call to? Who do you write to?
God. I think that's, I mean, you are, when you're the CEO, when you're the majority owner, the puck stops with you, you know? And so you are, it's lonely. And that's another kind of adjustment. And by definition, if you're trying to kind of pioneer a new area of the world, you're probably going to be alone. So it's hard to find thought peer groups and things like that to bounce ideas off. It's a lonely run in this field. And then as a CEO, it's kind of a derivative of that comment, but it's also very, very lonely. And so when shit hits the fan, you're on the hook. You know, it's back to like if you're running a fitness gym and the toilet blows up at 2 a.m, you're jumping out of bed to go fix it because it's your business. And that's kind of this owner, founder mode or whatever, but it's this owner's mentality where there is no one to call. You can call people and have them, ask them to feel bad for you. But at the end of the day, you're the single point of accountability that's got to get stuff sorted out.
So we were talking about the importance of game selection in the beginning, and and the goals and the lifestyle. So how has it been this part when it comes to your partner, kids, you being an employee, you now being a business owner, a lot of stress, a lot of responsibilities. How has it been? Because this is real stuff now. You can't get rid of this.
Yeah, totally. So I think of that under the kind of premise of lifestyle design. And so for me, it's been probably the most rewarding part. So my family, we were able to go live in Hawaii for 5 weeks to, quote unquote, house sit for my sister-in-law. And that's me choosing digital businesses that can be remote, et cetera, which was a very thoughtful decision. I work from home every day. And so, yes, that has its challenges. But if I go out for lunch, I have a spontaneous interaction with my 2-year-old son, and I get to chase him around the living room for 20 minutes. I'm not traveling. I'm not running huge teams, and my time isn't totally consumed with all these 1v1s and just this management noise. So the lifestyle design has probably been the most rewarding component of this track, period.
And has it been as you expected it to be?
I think so. But I mean, obviously there's too much kind of cognitive bias in our wiring. Like I think everything's probably 30% harder, 30% more costly, 30% longer than we think. So I try to kind of rationalize my expectations that way. And so far it's been, I'm as happy as I've ever been. My life is as rewarding as it's ever been. I feel blessed in every way. So I'm happy. I feel like I found my spot in the world, and it took me 36 years to get there. And I think that's another kind of lie. It's like, oh, you go to high school and then you go to college and then you find this job and it's a 45-degree angle up and to the right. It's like, nah, life is this constant feedback loop and just endless practice of discovery and trying to find the spot in the world where you thrive and where you're satisfied. And I think I'm grateful. Or for the first time, I'm not like, I'm doing this so I can do that. It's like, I'm doing this for the rest of my life and I can take big swings and it's risk on and I'm the single point of accountability and I'm willing to exchange that for the opportunity and for the lifestyle design.
So good. We should have started this. But let's wrap up with the famous five. How old are you?
36.
Favorite book?
Oh man, of all time. Ooh, I probably, God, what's Naval's book called?
Almanac? The Almanac or something?
Yes, the Almanac of Naval probably had the most impact on me. Beyond that, The Power of Now is up there. And then Revenue Architecture is just an exceptional read.
So married, single, kids?
Married with kid, one kid, Odie boy, 2-year-old.
What car do you drive?
911, 2001. I used to have a 1966 912 that I got when I was 16 and spent 20 years slowly refurbishing, but we had to sell it. because it just made no sense to have anymore. And so I did the thing and bought a more practical car, which was a 2001 911. But I'm kind of a Porsche head, so not the most practical in Colorado when it snows a foot, but it scratches my itches in the warm weather.
What's the best investment advice you've ever got?
Don't lose your principal.
And as you build in public, where can people find you?
Scaling, it's for the love of the game, which is kind of our mantra, but our Substack is Skaling Ventures.subs with a K. It's SKALING Ventures.com or .substack.com. If you look for us, you'll find us. We have a podcast on Spotify, and we also record to YouTube. And I'm pretty active on LinkedIn. I'm starting to get into the Twitter game a little bit more.
Okay, Kjael, it was a lot of fun. I'm not a SaaS guy, so probably there were some questions I left out because I just don't know enough about it. I'm not into the game every day. So, but thanks a lot for doing this. I really enjoyed this conversation.
Yeah, me too. And exceptional prep, very thoughtful questions. This was a lot of fun, man. Thanks, man.